TV. Welcome everyone to the Money Path. I am your host, Todd Schoenberger. Joining me today is Jim Bianco. He is the president of Bianco Research and a Fed expert because we're going to talk all about the Fed today. Jim, next week the Fed meets. Wall Street is anticipating a rate cut of 25 basis points. We just had very weak labor data from ADP on Wednesday, giving us a 2.5 year low print. And there's also some other softening signals that are out there. Do you think 25 basis points is going to cut it, though?
Yeah, I mean, yes, they're going to cut 25 basis points. It does seem to be that's the case. And you're correct that their focus is on the labor market and on the weakening labor market right now. But, not all the data is definitely weak here. We got initial claims number, which is current. That number was the lowest number in 3 years. Now, there might have been a Thanksgiving distortion in there, but it's certainly not going up right now. So it is kind of suggesting that, the number of people that are being fired now is not very high. We did get a Challenger Grain Christmas number, which was the number of announced layoffs. But those are maybe what you're going to look for in 26 and 27. That's in the coming months, we're going to lay off X number of people, not that we're laying them off tomorrow, is what. And so that's how you square that with the payroll report. But I also think there's another issue that seems to be pushed aside, and this might be problematic for the Fed and for the economy, and that's prices. The affordability is a real issue for the public. The inflation level, the cumulative rise of prices over the last 5 years is a real problem. And everybody's saying, ignore that, and we have to worry about jobs. But we got a political poll just yesterday. 46% of the American public said this is the worst affordability they've ever seen. Ever seen. Now, you might say, wait a minute, wasn't 2022 worse? Well, yeah, the rate of change was 9%, on
Yeah.
CPI. But I think what the public is telling you is that since 2020, the CPI is up 27%. Everything is 27% more expensive than it was 5 years ago.
Mm.
And that's what they're referring to. And if the Fed is going to say, that's not as important as signs of weakening labor, we need to cut rates, and this affordability problem gets worse, there might be hell to pay at the Fed for ignoring inflation like they did 4 years ago when they called it transitory and let
Yeah.
it run over to 9%.
Okay. So now let's unpack that a little bit, though. So even at 25 basis points, are you suggesting then they're looking to solve the labor issue? But the question I have for you, we had jobless claims yesterday, under 200,000. I mean, is there a real, I mean, I know it's fragile, but it doesn't seem like it is deteriorating at an expedited pace right now, but prove me wrong.
Well, yeah, there's two things about that is first of all, they're going to cut rates and they're going to mention that it's about jobs. And then you have to ask the question, all of these indicators that you have that jobs are weakening, is that because of softening demand that stimulating the economy through lower rates would fix? And I would actually answer the answer is largely no. The big numbers that we've seen in layoffs, you could attribute that to Amazon announced they're going to lay off 50,000 people because they're automating their warehouses. Intel is not laying off a whole bunch of people because they can't compete with NVIDIA. Dell is laying off a whole bunch of people because the PC cycle has changed. If you cut interest rates to zero 6 months ago, those people are still getting laid off. That is a structural problem you cannot fix with lower interest rates. What about recent college graduates, the unemployment rate's going up? If you break that down, what you'll find is male unemployment is going up, but female unemployment is not. Now, why is that? Because college graduates tend to graduate with degrees like in computer science and in finance, and those jobs are being affected by AI, and they're just not getting hired. Women tend to graduate with degrees like in healthcare, think nursing, or education, think teachers. Insatiable demand for those jobs. And that's why you've got a female unemployment rate between 22 and 27 around 4%, and a male unemployment rate 22 to 27 at around 7.5 or 8%. These are among college graduates. A point is, I don't know how lowering rates fixes that. And then the final thing that's slowing down jobs is what is the biggest driver of the supply of workers, and that is the population growth of the country. Now, on Tuesday, President Trump held a cabinet meeting. He said at the cabinet meeting, there has been zero illegal immigration in the country in the last 6 months. 6 months, excuse me.
Okay.
Now, what that means is that the population growth of the United States, because we've got no immigration right now, might either be zero or negative. There's only been one time in 250 years that the population growth has been negative in the United States. 1918, after the Spanish flu killed 20 million people. And potentially 2025. If you've got no population growth, then there's a question you have to ask, what is the labor break-even rate? How many jobs do we need to create? There's an argument to be made, a solid argument to be made. The number is zero. If you have no population growth, you don't need to create that many jobs. Maybe anything above zero is good enough. We don't need to create 100 or 200,000 jobs a month like we're accustomed to because of this dramatic slowdown. Point is, none of this can get fixed by lowering interest rates. But lowering interest rates could spur demand to create more inflation and exacerbate the affordability problem.
Well, let's talk a little bit about the inflation side, because yes, I saw your note yesterday talking about the Politico poll, and you are right. I mean, you could just everybody's impacted by these higher prices coast to coast. With that though, with the Fed, if there is an inflation issue, it starts really bubbling up again. Are we going to look back at this time of policy cuts and think that these were policy, this was the wrong policy to begin with from cutting because inflation still remains high and still is an elevated risk?
It's very possible. I mean, I think that we might be very well looking at policy errors. And I would suggest that the market might be getting a little bit uneasy about policy errors too. And let me pivot to the Fed. It looks like Kevin Hassett is going to be the next Federal Reserve chairman. All indications are that's who President Trump is going to pick. Now, if you look to the betting markets like Polymarket or Kalshi, he's trading at around 70 to 75% probability that he's going to be the Fed chairman. Wait a minute, why isn't he trading at 95%? Why is he trading at 70? Because there's a big pushback coming from corporate America and Wall Street. Look, Trump wants the funds rate at 1%. All right, well, that's fine. He could bloviate all he wants about a 1% funds rate. But now with Kevin Hassett in charge, maybe he actually will get a 1% funds rate. And that's a mistake. In other words, an aggressive rate cutting cycle is a mistake. And it's got people very nervous that might spur inflation and actually push long-term interest rates up. So now all of a sudden, yeah, we're starting to worry about, are we cutting rates too much? Maybe next week's cut to 3.5 to 3.75 range on the funds rate is not too much. But if that's the next in a series of a lot more cuts, then there's going to be a lot more nervousness that we're ignoring the affordability problem. We're trying to fix a labor problem we can't fix with interest rates, and we're just going to wind up creating more inflation. And if we put a guy in charge whose mandate is, I don't care what the data is, we have to keep cutting and cutting and cutting, that could actually make things worse, not necessarily make things better. And that's where the pushback's coming from.
So is there more risk to cutting too much or not cutting at all at this point?
I think there's more risk to cutting too much. And to that end, I think the thing you want to watch to talk about the risk of cutting too much is that something very unusual might happen at next week's meeting. We might get a lot of dissents. Now, normally a Fed meeting is 12-0, 11-1, and the way the Fed has worked for decades was everybody tells the Federal Reserve Chairman what they think, how they believe things should be. He seriously listens to you, and then he makes a proclamation, okay, we're going to do this, and everybody votes for it. Now, between meetings, you could come into my office and you could say, I think this is wrong, we should do something else, but you're going to vote the way I say you're going to vote. And that's why all the votes are 12-0 or 11-1. There's a serious argument to be made that this vote might be 7-5 or 8-4. In other words, those 12 members of the FOMC are now starting to act independently. and they're going to vote on the policy that they think is going to be the best policy. Since the last Fed meeting, everybody but Jay Powell has given a speech. And there has been 5 of the voters who have given speeches that have effectively said, I don't think we should cut rates at December. Okay, are you going to follow through now and you're going to dissent? If they do, and we get a 7-5 or 8-4 vote, I think that would be bullish for the bond market, because it would say maybe Hassett gets the job and maybe Trump emboldens him, take the funds rate to 1%, but we're not going to vote for it. And if you don't have our vote, it isn't going to happen. And that could actually alleviate those fears that the Fed goes too far. If they all cave and we get another 10-11-1 vote, then the fears will be heightened. Yes, that, Hassett will come in, Trump will tell him, you better cut rates to, 1%, or I'm sending SEAL Team 6 in to remove you from office and find somebody else. And then we're going to get very worried that we're going to go too far. So ironically, next week, I think the most important thing to watch is, where are the dissents? How many do we get? Do we get, 5 or 4, or do we wind up with 0 or 1 or something along those lines? So we'll have to see how everybody lines up.
So in the meetings that occurred this year, what were the ratios like for the dissents?
11-12-0, 11-1. We just had a meeting, the last meeting in October, it was 10-2, but one of those dissents was Stephen Mirren, who wanted to cut 50, so it was in the same direction. And another one was Schmidt from Kansas City, who said that he didn't want to cut it all. But 2 meetings ago was 12-0 is basically what the vote was.
So here we are at the end of the year. We have a change in leadership that's about to take place within the FOMC. Why the change now? Why are there so many dissents? Is it because there's certain pockets of the country that are worse off than others?
I think it's a combination of 2 things. I think it's Trump's incessant bashing of the Fed, and that they're worried about independence. And the way that they could show that they're independent is, we don't just do what the chairman tells us. We are independent. That's what they're supposed to be. Is, Federal Reserve governors are appointed by the president and approved by the Senate. And your boss, if you're a Federal Reserve governor, is the American people. You're supposed to do what's right for them. Your boss is not, let me repeat this again. Your boss is not the Federal Reserve chairman. He is irrelevant to your decision-making process. So I think that there's a pushback because of all of the bashing that Trump had. And then Stephen Mirren has come in. And whether you agree with him or you don't agree with him, and some of the things he says, about policy and the outlook, I don't agree with. But more importantly, he has written long blog posts. He does hour-long interviews. He is breaking the mode of how Federal Reserve governors react by being completely independent, explaining himself on hour-long interviews, putting out multi-page posts on the Federal Reserve's website to explain his different opinion. And I think a lot of the other members are going, maybe I should be like that too. That, I should be out there not just parroting Fed points on a 5-minute CNBC interview, but maybe come on with you for a half an hour, 45 minutes, and after I've put out a white paper to explain why I am going to vote a certain way. And so that independence is starting to come back into the Federal Reserve.
Yeah, well, we would welcome all the Fed governors on our shows. But with that said, though, that really is it opens up a Pandora's box, because now you have Fed governors that are now making decisions to almost say, hey, they're being stubborn. I'm not going to make a change or vote a certain way because the president of the United States is saying something. Doesn't that completely go against the spirit of independence? Because the Kevin Hassett thing, and you brought him up, is that you have Wall Street executives now that are lobbying the president, saying, don't bring him on as Fed chairman because we need independence.
Right. Now, that'll be the big question. The big question will be, are you dissenting because you're just saying orange man bad and I'm just going to do the opposite of what the orange man wants? That's not independence is what that is. That's intransigence is what it is. Right. Or are you saying that, look, for months and months, I have been telling Jay Powell quietly, I don't think we should be cutting rates. I don't think we should be cutting rates. But the protocol at the Fed is, I tell you this quietly, and then you say we should, and then I vote for it. But now I'm going to say to you privately, I don't think we're going to cut, we should be cutting rates. And I'm going to dissent on a rate cut at the meeting. If that's what you're doing, then that is independent. And that's why, at least with Mirren, you'll have to do more than a 5-minute CNBC interview to explain that. And, go out with white papers, go out with long form interviews and stuff like that to say, this is exactly what I'm looking at. This is my conclusion. And this is why I'm voting a certain way. And then it'll be up to the investing public to say, yeah, you're acting independently. And maybe I don't agree with you. Look, I don't agree with Stephen Mirren, but I applaud that he is doing it in an independent-like manner, and that's good. But I think if the rest of them do this that way, then yeah, it would be viewed as independent.
In your opinion, what's the future of the Fed look like, especially if Kevin Hassett gets in there and there is this sense of we want rate cuts or else?
That's a good question, because if you look at Kevin Hassett as his record, his resume on a sheet of paper, you would conclude Harvard educated, Harvard economist, worked in various White Houses, has written books about markets and the economy. He is eminently qualified to be Federal Reserve Chairman.
Yeah.
If that's the Kevin Hassett we get, his curriculum vitae, Kevin Hassett. Yeah. But if we get a Donald Trump mouthpiece to push funds to 1% because that's what Donald Trump wants, that's a problem. So I don't know which Kevin Hassett we're going to wind up getting. And that's going to be the big question. And we'll have to see. Now, Hassett himself is put in a very difficult position because he's effectively becoming the shadow Fed chairman, right? Because we know he's going to be the next guy. So we're going to be paying very close attention to what he thinks. I have to believe he does not 100% agree with the president. That doesn't mean that that the president's wrong or he's wrong or right or anything, but no one can 100% agree with somebody else. And does he express that somewhere between now and May when the job comes in? And if he does, and he diverges from the president's viewpoint, does Trump anger with him and say, well, maybe I'll go pick somebody else then because I haven't quite nominated you? Or does he just fall straight in line and whatever Trump says, I agree with, and we got to do this because this is what the president wants? And that will probably go a long way to tell us which Kevin Hassett we're going to wind up getting.
Okay. So on Wednesday, the Fed decision at 2 o'clock Eastern, 2:30 is the press conference with Jerome Powell. I send my media credentials to you, Jim. You go in there, you're representing Bianco Research at BTT. You have the microphone. You have one question to ask the chairman. What is the question and what can he answer that's going to surprise you?
If I will assume that there's a number of dissents at this meeting, and the question I would ask him is about those dissents. Is this new for the Federal Reserve, or if these people were voting independently the last several meetings, would we have seen several dissents at those meetings as well too? Were those dissents suppressed? And if they were suppressed, why were they suppressed?
Wow, great question. And I'd imagine any answer he gives, because that's a great question. I wonder if the people that are watching this will probably ask that question. But if he answers,
I hope so, because I hope they don't ask the questions of how mean is the orange man, and and those seem to be the questions that they always ask him. Yes. And stuff. The drama between him and Trump. I don't think that's very relevant to be bothering him with.
No, I agree with that. But if the chairman answers your question and says, yes, we had a number of dissents, they just didn't publicly vote that way, what does that do to the markets?
I think what it shows you is that I think the markets would take it bullishly. And because I would say it shows you that they were doing what Powell wanted. And in the future, when Kevin Hassett's there, he might say, look, we need to cut rates. And he might look around that room and go, I don't have 7 votes to cut rates. And so therefore, we're not going to get a rate cut. Maybe he doesn't even bring it up in the first place. And is the way I've liked to said, Fed watching is shifting. It used to be, what does the chairman think? watch the chairman in his speeches and dissect and parse all the words that he says. Now it's kind of like the Supreme Court. It's vote tallying. Okay, which way is Goolsbee going to vote? Which way is Schmidt going to vote? Which way is Mirren going to vote? Which way is Bowman going to vote? And you tally them up and you put them in the cut, hold, or height columns, and then you say which column is 7. Okay, that's what they're going to wind up doing. Dissents will be the new forward guidance. The Fed loves forward guidance, meaning tell me what you're going to do in the future. Well, we'll know from the dissents. If you have a meeting and you have a 7-5 vote, that means you're close to the end. If you have a meeting and you have a 12-0 vote, look, even in an independent Fed, you could still have 12-0 votes. That means you're all on board. We're going to keep doing this for a while. It's basically, so that's where the dissents will be the new forward guidance.
Okay, so let's pivot quickly on this then. Let's talk about the jobs report. The combination of jobs coming out for October and November that's rolling out on the 16th, I believe. What is your take on this? Because the inflation data they're going to do the same type of combination. Can the Fed actually dissect the numbers reasonably?
Yeah, they can dissect the numbers, and we can, but it's just going to be different because what you're going to get is you're going to get two numbers at once. You're going to get a November number and an October number for the payroll report. And so, you're going to have to start looking at two numbers at the same time and say, what do they say? Remember now, September's number was over 100,000 jobs. So we had a very, very strong September number. There is an expectation that was above trend. So either the combination of October and November should be a little bit below trend, and that how to net those two. The difficulty, if I could switch a little bit, is to the CPI report. There's going to be no October number. They never collected the data, and they can't go back and collect the data. So they're going to put out a November number, and it might say 0.5, or it might say 0.4. And you might go, man, that's a big number. Yeah, but that's a 2-month change because there was no October number. So what do we do? Do we divide it by 2? Or how do we kind of, figure this out? Because now we're going to get a 2-month change, something we're not used to. So we're going to have to, understand with these numbers we're going to get, it's going to take a second level of understanding them before we get back to the, typical monthly cycle that we've been used to.
Yeah. So going forward, though, if this ever happens again, do you think that the Bureau of Labor Statistics, that department, should be looked at maybe as a disaster prevention type of department that has to remain working?
Yeah, you could argue that, as well. I think what's going to happen if this happens in the future, again, when we have a protracted government shutdown, is we're going to start looking at alternative data sets, and we're going to find them to be somewhat irrelevant. Let's be fair. Why do we care so much about the government data? Is it because the government data is better than, say, private sector data? No. It's because the Fed sets policy off the government data. And that's why we care about it. And what you might wind up having in the future is the Fed might start looking at private sector data and using that as a major gauge of trying to set policy. Look, we were very close to that 2 years ago when the Fed was basically promoting the University of Michigan Consumer Confidence Survey and their inflation expectation survey as almost important as the government data. So they've done it in the past, and they could wind up very well doing it in the future again. So it's really about the Fed. The Fed targets the unemployment rate. The Fed targets the CPI rate, and that's where they decide on policy. They don't decide policy on truflation or some other measures, alternative private sector measures. Price stats would be another one that are in the private sector, or on ADP, or on any of that other data. They do it on the government data.
So one final question then for you, and it's a silly question, but you know how the BOS comes up with the monthly number, the monthly non-farm payrolls number. Could any independent outlet do the same thing?
If they had enough money, they could. They basically survey 60,000. They survey 100,000 businesses to get 60,000 responses. That takes a lot of money. But I would argue to you, I've jokingly said this. There's a company out there that's $500 billion in market cap. It's called Palantir, and Palantir is a big data company. And I've often argued that I bet you if you called Alex Karp, the founder of Palantir, and said, Alex, we'd like you to come in here and we'd like you to create a new, transparent way of calculating the unemployment rate and payrolls. And Alex, would you do it for free as a gift to the United States people? He'd probably say yes. And he'd probably find out a way to do it, and we would have a better way to do it. I think the problem is the way that they do this report now is that they look at survey data. It's surveys, right? It's calling companies and asking them their opinion. I think the proper way to do it is something akin to what ADP does. Why don't you just connect to the IRS database and look at all 160 million withholding data from tax withholding data and try to calculate it off of actual, what they refer to as administrative data, as opposed to surveys. I think what we need to do to kind of get rid of this system is we need to kind of transition away from the surveys and go more towards actual data.
That's interesting. So when they call the 100,000 companies, the businesses, and asking them if they're hiring, firing, whatever, I assume it's not the same 100,000 companies every month, right?
No, it is. It actually is. Now, to be fair about it, about half of those companies actually sign a release. And what they do is they say, our payroll processing company, which is ADP or maybe somebody else, just give them a file every month with all the data that they need. And that's what they do. So about half the data they get is actually automatically transferred to them as that actual administrative data. The other half, they actually reach out to the companies to ask them to fill out a survey with the data. But I'm saying what they should be doing is they should be going 100% to that administrative data as opposed to the surveys. Because even companies, take my company, eight employees. We still use a payroll processing company. And we've actually been asked whether or not we want to submit our data to the BLS. Probably Yahoo has too, in the personnel department. And maybe we checked off yes, maybe they check off yes. By the way, the data that they send them is everything but your name and social security number. So it's metadata is what they tell you. Everything else about you except your name and your social security number. So your privacy is protected if you do check off that number as yes.
Okay, that's amazing. That's some great education right there. I never knew this, and I'm sure the audience didn't know as well. So I appreciate the explanation. Jim, thank you so much for joining me today. I want to wish you a very Merry Christmas, and I would love to have you back, especially next year with the change in leadership at the Fed.
I would love to come back next year and talk about it. Thank you, and Merry Christmas to you.
Thank you. Thank you so much. So on behalf of Jim Bianco, I am Todd Schoenberger. Joining me on Tuesday, Michael Green from Simplify. He's coming on the show one-on-one to talk about his report regarding poverty. Definitely want to catch that. So until then, take care. All right, Jim, that was fantastic. Thank you so much.
Thank you.
Oh, I should have said